That's a great point. So let's bring in the experts then on the technicals. We have Larry Shover. He's Chief Investment Officer at SFG Alternatives. And on the fundamentals, we've got Dean Kernet, President and Founder of Macro Risk Advisors. Larry, let's start with you. Dom just mentioned Amazon and Apple reporting. Given their size in the NASDAQ, could they stop this wandering around in the markets that we see right now? Could they provide upside to the market?
There definitely could be some upside to the market. I think after today, it's the biggest micro day we've had in Q3. If earnings come out anywhere near expectations, I think we'll go back to being macro focused, realizing China's stable, our numbers are stable, Europe's not falling off a cliff. So we definitely have some upside potential. And I'd like to say actually a beta chase will continue.
Now, Dean, we talk about the macro, and you work for a company. You founded a company called Macro Risk Advisors here, but you're focusing a little bit more on the micro, the company-specific aspects of the market right now. You don't think it's all about the correlations, the trading relationships going up and down together. There's still some value to be had for picking the right investments at the right time. Is that correct?
Well, yeah, certainly more so than we've seen over the past couple of years, which really has been defined in a lot of ways by this very risk-on, risk-off macro trading paradigm. More recently, I think Europe is certainly not even close to out of the woods, but they've got a little bit of a respite. They bought themselves a little bit of time, and so that gives investors a chance to focus a little bit more on the micro, as you said, on earnings-specific stories. And I think what we're seeing is some headwinds on the earnings side. With respect to what's been reported so far, I think the degree of negative surprises has been a little bit disappointing, and the guidance hasn't been great.
So far, Dean, the theme in the markets has been you don't want to fight the Fed, yet you're feeling a little bit more bearish than neutral these days.
Yeah, I think, look, fighting the Fed has been incredibly challenging for investors. There's no shortage of bearish indicators out there. We know that the fiscal trajectory of most of the developed world is unsustainable, specifically Europe. The U.S., of course, has got some pretty significant fiscal challenges, and yet Bernanke has made it really tough. He's suppressing interest rates. He's creating a very high opportunity cost of doing nothing. And when you get the S&P up 13 or 14%, so far this year, you do wind up with some, benchmarking, some performance chasing.
Now, Larry, let's talk about the levels that Dean was just speaking of here. We do have an S&P 500 that's up 13-14% for the year. Not too shabby, given the fact that we're in a volatile election year. We got the fiscal cliff concerns coming up here. Is it perhaps just foreseeable that the markets might pull back here for a bit, consolidate, give it a bit of a rest here? And if so, from the technical side of things, what levels are you watching in the S&P 500 to kind of give you an indication of where we head from here?
Well, as you said, Dominic, the one I'm watching is really 1,400. That seems to be a big support level. Given the headwinds that we've just seen, I mean, the fact that we've held up around 1,400 is a very, very good sign. And once the market goes back to being macro-focused, we'll all realize that it's all relative. And the fact that equities are still cheap when compared to treasuries, when compared to MLPs, REITs, what have you, and we will continue to march higher. It's not going to be a straight line, but we will continue to march higher.
Dean, let's bring you back into this conversation. When we look at the S&P 500's move, it's down. It's little change at the moment, just down ever so slightly. Yet, in the past 2 weeks, we've seen moves of greater than 1%, 3 different times. This is a huge sea change from what we're seeing earlier this year.
Right. So my firm, Macro Risk Advisors, focuses on studying events of volatility. And one of the things we learn is that volatility events tend to perpetuate themselves for periods of time, meaning a market that's volatile today is more likely than not to be volatile tomorrow. And the reverse is certainly true as well. If the market's not moving, that muted volatility tends to become self-fulfilling. So more recently, with these 3 rather large moves, I think there is some sort of sentiment change potentially at hand. It's certainly not guaranteed to happen, but the market is playing a little looser, to use a poker term, with the larger swings back and forth. And whether that becomes a little bit more self-perpetuating, I think is a function of the data. It's a function of where we go with respect to things like the fiscal cliff as well.
Now, Dean, the market has rewarded investors who have held onto those stock positions, but you don't think that now is the time to be complacent about things. You think you should be actively managing your risk. How would you go about doing that?
Well, look, what we've learned over the past 4 or 5 years is that risk can come to the market very quickly. And sometimes I think we tend to spend a lot of time as investors trying to focus on what what caused the market to move. And the reality is markets are this just huge supply-demand allocator. And it's sometimes difficult to know in advance why a market will become more volatile.
Right.
The reality is that the options market does provide a lot of opportunity to express views to either the upside or the downside in a way that preserves capital.
Gotcha. All right. Thank you to Larry Shover, CIO of SFG Alternatives. Dean Kernett, president and founder of Macro Risk Advisors, will stay on with us.
Well, here's what you need to know here for